Silver just hit a 45-year high at $79 on 35. And if you're watching this, you're probably asking yourself a very simple but uncomfortable question. Did I miss the boat? Or is $80 just the pit stop on the way to $100? That question is everywhere right now, and it's completely reasonable. When prices move this fast, the emotional pressure to act becomes intense. People start to feel like every minute they wait is costing them money. And that sense of urgency is exactly what leads otherwise rational people to make poor decisions. The faster the market moves, the louder that inner voice becomes, telling you that hesitation equals failure. This is where most retail investors get hurt. What's important to understand right away is that this feeling is not accidental. Markets are designed to create emotional stress at turning points. When an asset has been ignored for years and then suddenly starts making headlines, it creates a powerful fear of missing out. That fear feels logical, but it rarely is. The purpose of this video is not to convince you to buy silver immediately or to scare you into staying out. The goal is to help you understand what kind of moment this actually is and how people historically succeed or fail when prices reach levels like this. Most people don't lose money because they are wrong about silver long term. In fact, many people who lose money were directionally correct. They believed silver would go higher, and eventually it did. The problem is that they entered at emotionally charged moments without a plan. Buying near highs without understanding volatility is one of the fastest ways to turn a good thesis into a bad outcome. Silver is notorious for this because it does not move smoothly. It surges, it stalls, it pulls back hard, and it tests conviction relentlessly. At $79 to $80, silver feels expensive, not just financially, but psychologically. That's because most people are anchored to much lower prices. For years, silver trading in the 20s and 30s became the normal reference point. When an asset breaks out of a multi-dead range, the human brain struggles to update its internal sense of value. We instinctively assume that what just happened is unsustainable, even when the fundamentals say otherwise. This disconnect between price action and perception is where confusion lives, and confusion is dangerous in markets. There's another mistake that tends to appear at moments like this. People start thinking in extremes. They tell themselves there are only two options: buy now at any price, or stay out completely and miss the move. That kind of thinking removes flexibility, and flexibility is one of the most valuable assets an investor has. Professional investors rarely make all-in decisions at emotional extremes. They think in probabilities, scenarios, and time horizons. They prepare for more than one outcome at the same time. It is also crucial to understand that silver at $80 is not the same market that silver was at 25 or 30. The participants have changed. The reasons people are paying attention have changed. Institutional capital, industrial demand, and macroeconomic forces are far more involved now than they were when silver was cheap and ignored. Treating this like a simple speculative spike ignores that evolution and leads to poor comparisons. When silver was trading lower, it attracted mostly contrarian investors and long-term holders. At higher prices, momentum traders, hedgers, and new retail participants all enter at once. That mix increases volatility. Doesn't mean the trend is over, but it does mean that price behavior becomes more complex. Moves become sharper, pullbacks become faster, and sentiment can shift dramatically in short periods of time. Another key reality check is time. Markets rarely move in straight lines. Even in powerful bull markets, price needs to pause, digest gains, and test conviction. When silver approaches psychologically important levels like $80, it often attracts both new buyers and profit takers at the same time. That tug-of-war can create choppy, frustrating price action that shakes out people who entered without understanding what they signed up for. None of this means silver can't go higher from here. It absolutely can. What it does mean is that buying silver today without a plan is very different from buying it months or years ago. The risk profile has changed. Upside still exists, but so does the potential for volatility that feels uncomfortable if you're unprepared for it. This is why the question, "Did I miss the boat?" is the wrong starting point. Boats don't move in markets. Cycles do. Silver is in a different phase of its cycle than it was before, but that doesn't mean opportunity has disappeared. It means opportunity now looks different. It requires patience, structure, and realistic expectations rather than urgency and emotion. Once you accept that, the conversation becomes much more productive. Instead of reacting to price, you can start evaluating why certain levels matter, why so many people are talking about $100, and whether that focus actually helps you make better decisions. That brings us to the next part of the discussion. Why $100 has become such a powerful magnet for silver prices, and what are really driving that narrative. One of the biggest reasons you keep hearing the number 100 come up in conversations about silver is because markets are drawn to round numbers once long-term resistance is broken. This is not superstition, and it's not hype. It's how human psychology, media narratives, and institutional positioning interact with price. When an asset breaks out to levels not seen in decades, participants don't anchor to precise technical levels anymore. They anchor to simple, memorable milestones. In silver's case, $100 is that milestone. But the magnetism of $100 is not just psychological. There are real structural forces pulling silver higher. And the most important one right now is industrial demand that does not care about price. Unlike speculative demand, which tends to disappear the moment prices stall or pull back, industrial demand is driven by production requirements. Companies don't buy silver because they think it's cheap or expensive. They buy it because their products cannot function without it. This is especially true in sectors like artificial intelligence, hardware, solar energy, and advanced electronics. Silver is one of the most conductive metals available, which makes it critical for efficiency and reliability. As AI data centers expand, as renewable energy infrastructure grows, and as electronics become more complex, silver consumption increases structurally. This demand is baked into long-term plans and capital expenditures. It doesn't turn off just because the spot price goes up. This creates a dynamic that many retail investors underestimate. Rising prices don't necessarily kill demand in silver's case. In some situations, they actually accelerate buying as companies rush to secure supply before it becomes even more expensive or scarce. That kind of behavior changes how markets respond to price increases. Instead of higher prices leading to less demand, higher prices lead to tighter supply, and tighter supply feeds back into higher prices. At the same time, investment demand is returning. For years, silver was largely dismissed as dead money. It underperformed other assets, and holding it required patience that many people didn't have. Now that price is moving decisively, attention has shifted. Investors who ignored silver for years are suddenly reevaluating it, not just as a trade, but as part of a broader macro strategy. When investment demand and industrial demand rise together, price behavior changes dramatically. The second major force behind the $100 discussion is the US dollar. Precious metals and the dollar are deeply connected, even when that connection isn't obvious day to day. When the dollar weakens, it takes more dollars to buy the same ounce of silver. That doesn't mean silver is becoming more valuable in absolute terms. It means the currency is losing purchasing power. Right now, the macro environment is increasingly hostile to sustained dollar strength. With the Federal Reserve facing pressure to cut interest rates, the direction of policy matters. Lower rates reduce the opportunity cost of holding assets that don't generate yield like silver. More importantly, rate cuts signal that economic conditions are not as strong as advertised. Historically, that combination pushes investors toward hard assets that cannot be printed or diluted. For U.S. viewers, this matters because silver is priced in dollars. When confidence in the dollar erodes, silver naturally becomes more attractive as a store of value. You don't need hyperinflation for this dynamic to play out. Even modest currency weakness over time can have a powerful impact on assets with limited supply. This is one of the reasons silver often lags initially and then moves aggressively once the trend becomes undeniable. Another reason $100 acts like a magnet is media behavior. Financial media is reactive, not predictive. They don't spend much time talking about assets until those assets reach levels that force coverage. A move from $25 to $40 is easy to ignore. A move from $40 to $80 becomes harder to dismiss. A move toward $100 turns silver into a headline asset. And once that happens, attention increases exponentially and attention attracts capital. This doesn't mean media coverage causes higher prices, but it does change who participates. New buyers enter not because they understand the fundamentals, but because silver has become important again. That late arriving capital can push prices further than fundamentals alone would justify in the short term. This is why markets often overshoot both on the upside and the downside. However, it's critical to understand that magnetism does not equal safety. Just because $100 is a logical narrative target does not mean the path there is smooth. In fact, the stronger the magnet, the more violent the swings around it tend to be. The same forces pulling silver higher also increase volatility. Momentum attracts traders. Traders increase leverage, and leverage amplifies both gains and losses. This is where a lot of people get caught off guard. They see strong arguments for higher prices and assume that means buying now is risk-free. It isn't. Strength can continue, but it can also pause or retrace sharply without invalidating the larger trend. Understanding this distinction is what separates disciplined investors from emotional ones. It's also important to recognize that $100 is not a destination. It's a reference point. Markets don't stop moving just because they hit a nice round number. Sometimes they consolidate below it for extended periods. Sometimes they blow through it faster than anyone expects. The outcome depends on positioning, liquidity, and external conditions, not on the number itself. So when you hear people confidently declaring that silver is definitely going to $100, you should ask a more useful question. What happens between here and there? What kind of volatility should you expect? Where are buyers likely to hesitate? Where might sellers emerge temporarily? Those questions matter far more than the headline target. This brings us to the risk side of the equation, because while there are strong reasons why silver is being pulled higher and why 100 has become such a powerful magnet, there are also very real dangers to buying aggressively at $80 or $80 without understanding how markets behave around round numbers. That's what we need to talk about next. Now, we need to talk about the part of this move that almost nobody wants to hear when prices are rising. The risk. Not because silver is weak, not because the long-term case is broken, but because markets behave very differently around major round numbers than they do in quiet accumulation phases. When silver approaches a level like $80, behavior changes across the entire market ecosystem. That change creates opportunity for some and pain for others, depending entirely on how prepared they are. Round numbers matter because humans give them meaning. Traders watch them. Media highlights them. Algorithms are programmed around them. Large institutions know this, and they use that knowledge strategically. When silver pushes into a major psychological level, it becomes a natural place for profit-taking, position adjustments, and short-term counter-trend trades. None of that means the rally is fake. It just means that the path forward is rarely a straight line. This is what many people refer to as the retail trap. And it's not a conspiracy, it's a behavioral pattern. As price approaches $80, excitement peaks. Social media fills with bold predictions. New buyers rush in because they feel like hesitation equals missing out. At the same time, earlier buyers who entered much lower begin to lock in gains. Large players may reduce exposure or test liquidity by selling into strength. That clash often results in a pullback that feels shocking to anyone who bought near the highs. The danger here is not the pullback itself. Pullbacks are healthy. The danger is buying without understanding that pullbacks are likely and then reacting emotionally when they happen. Someone who buys silver at $80, expecting immediate continuation to $100, is far more likely to panic sell on a drop to $74 than someone who planned for volatility from the start. The market doesn't punish belief, it punishes poor planning. There's also an important distinction between price discovery and price exploitation. Big financial institutions are not emotional. They don't chase headlines. They understand where retail sentiment tends to cluster, and they know how to use that information. When silver reaches a level that grabs mainstream attention, liquidity increases. That liquidity allows larger players to execute strategies that are not possible in quieter markets. That doesn't mean manipulation in a dramatic sense. It means taking advantage of predictable human behavior. Another layer of risk that is especially relevant right now is the premium problem. Many people focus entirely on spot price without considering what they actually pay to acquire physical silver. If spot is $79 and your local dealer is charging $90 or $95, you're not buying at today's market price. You're effectively locking in an assumption that silver will rise significantly further just to break even. That changes your risk profile dramatically. Premiums tend to expand during rallies because physical supply tightens and dealer risk increases. That's normal. But from the buyer's perspective, it requires extra caution. High premiums reduce flexibility. If silver pulls back sharply, spot prices may fall quickly while physical premiums take time to compress. That can leave buyers feeling trapped even if the long-term thesis remains intact. This is particularly important for U.S. buyers because physical silver markets can lag futures markets. Futures can fall rapidly during sell-offs while physical availability remains tight. The disconnect creates confusion and frustration. Someone watching spot prices drop might expect physical prices to follow immediately, only to find that dealers are still charging elevated premiums. Understanding this dynamic in advance helps prevent emotional reactions when volatility hits. Paper markets introduce another type of risk. ETFs and futures provide liquidity and convenience, but they also expose holders to sharper price swings and, in some cases, forced decisions. Leverage amplifies this effect. Traders using margin can be forced out of positions during pullbacks, even if the long-term trend remains bullish. This is one of the reasons silver rallies often feel chaotic. Leverage accelerates both sides of the move. It's also worth remembering silver's personality. Silver is historically more volatile than gold. It overshoots, it corrects violently, and it tests conviction more aggressively. People who are comfortable holding gold through drawdowns often underestimate how emotionally taxing silver can be. That's not a reason to avoid it, but it is a reason to size positions appropriately and manage expectations. Buying silver at $80 without acknowledging these risks doesn't make you optimistic. It makes you vulnerable. Optimism paired with preparation is powerful. Optimism paired with impulse is dangerous. The market doesn't care how strong your conviction is if your position sizing and entry timing can withstand volatility. Another often overlooked risk is narrative fatigue. When everyone starts talking about the same price target, the market can temporarily stall under the weight of expectation. Too many people positioned the same way reduces incremental buying power. That's when corrections tend to happen, not because the story is wrong, but because the trade becomes crowded in the short term. None of this means silver one reached 100. It means that the journey there is likely to be uneven, emotional, and unforgiving for those who enter without a plan. Understanding where risk lives doesn't weaken your thesis. It strengthens it by helping you survive the journey. This is the point where many investors make a crucial decision. They either accept that volatility is part of the process and adjust their strategy accordingly, or they continue reacting emotionally and blaming the market when things don't go smoothly. The difference between those two paths often determines whether someone benefits from a long-term trend or becomes another cautionary tale. That brings us to the final question. How do you actually approach this situation intelligently? If silver really is entering a new phase, what does a rational strategy look like for someone deciding whether to buy now or wait? That's what we'll cover next. Because having a plan matters far more than being perfectly right about direction. At this point, everything comes down to strategy, because understanding the market without a plan is no different than guessing. Silver at $80 is not a simple yes or no decision. It's a fork in the road. And the correct path depends on who you are, how you think, and how much volatility you can realistically tolerate. This is where many people make the mistake of copying someone else off conviction instead of building a strategy that actually fits their own situation. Let's start with what I'll call the brave strategy. This approach is for people who genuinely believe that silver is entering a long-term repricing phase and that the current move is only the beginning. If you believe silver is heading well beyond $100 over the coming years, then buying at $80 can still make sense. The key assumption behind this strategy is time. You're not buying silver for a quick flip. You are buying it with the understanding that there will be volatility, pullbacks, and periods where price action feels uncomfortable or even discouraging. The brave strategy requires emotional discipline. You accept that silver might drop 10, 15, or even 20% at some point without invalidating the long-term thesis. You're prepared to ignore short-term noise, headlines, and social media sentiment. You size your position in a way that allows you to sleep at night, even if the market moves against you temporarily. This approach works best for investors who are focused on wealth preservation, long-term cycles, and macro trends rather than short-term trading gains. However, bravery without structure is not bravery, it's recklessness. Even if you believe strongly in silver's future, that doesn't mean you have to deploy all your capital at once. Many long-term investors choose to scale in, buying a portion now and leaving room to add on weakness. This reduces emotional stress and prevents the feeling that you made a single all-or-nothing decision at a highly visible price level. Now, let's talk about the patient strategy, which is often misunderstood. Waiting is not the same as giving up. Patience is an active choice, not indecision. If you recognize the long-term case for silver, but don't feel comfortable buying at $80, setting buy limits lower can be a rational and disciplined approach. A range like $72 to $75 reflects the reality that even strong markets retrace. Volatility is not a flaw in silver, it's a feature. The patient strategy accepts the possibility that you might not get filled. Silver may continue higher without looking back. That's the trade-off. But by waiting for a pullback, you improve your risk or reward profile. You reduce the likelihood of immediate regret and give yourself a margin of safety if volatility picks up. This approach suits people who value precision, risk control, and emotional stability over certainty. There's also a hybrid approach that many experienced investors use, whether they realize it or not. They commit a portion of their intended allocation now to establish exposure and avoid the fear of missing out entirely. At the same time, they keep capital in reserve for pullbacks. This creates flexibility. If silver dips, they buy more at better prices. If it doesn't, they still participate in the upside. This approach reduces psychological pressure and keeps decision-making grounded. Another important factor is the distinction between physical silver and paper exposure. Physical silver is slower, heavier, and more expensive to move in and out of. It makes sense for long-term holding and insurance against systemic risk. Because of premiums and liquidity constraints, physical silver generally rewards patience and planning. Paper exposure, on the other hand, offers flexibility and liquidity, but comes with its own risks, including volatility, leverage effects, and emotional overtrading. Knowing which vehicle you're using should influence your strategy significantly. It's also worth being honest about intentions. If you're buying silver because you believe it will protect purchasing power over time, then short-term price fluctuations should not dominate your thinking. If you're buying silver because you expect a rapid move to $100 and beyond, then you're trading momentum, whether you label it that way or not. Neither approach is wrong, but confusing the two leads to frustration. This is why copying someone else's confidence is dangerous. Social media is filled with absolute statements, bold predictions, and emotional certainty. What you don't see are the position sizes, the time horizons, or the risk management behind those statements. Your strategy should be built around your own financial reality, not someone else's conviction. I'm not a financial advisor, but here's how I think about it. I respect the long-term case for silver. I recognize that structural forces, industrial demand, and macro conditions are supportive. At the same time, I respect volatility in history. I don't assume that just because silver is strong today, it can't pull back tomorrow. That means I favor strategies that allow for participation without emotional overexposure. What I try to avoid at all costs is decision-making driven by urgency. Markets are patient, people are not. Urgency creates tunnel vision and shortens time horizons artificially. When you feel rushed, you stop evaluating risk clearly. Taking a step back and acknowledging uncertainty is not weakness. It's how you survive long enough to benefit from long-term trends. Silver at $80 is not a final answer. It's an invitation to think carefully about risk, timing, and purpose. Whether silver goes to 100 OS next month or takes a longer, more volatile path, the principles remain the same. Discipline matters more than prediction. Structure matters more than conviction. And patience often outperforms excitement. If you can build a strategy that reflects those principles, you put yourself in a position to benefit regardless of short-term fluctuations. The market will do what it does. Your job is not to control it, but to respond intelligently. That's how people stay in the game long enough to